Welcome to Opalesque TV. I am in London at the London Business School. We're having another series of the Opalesque Campus where we actually go and see the leading academics that do research on hedge funds. Today I am with Professor Narayan Naik. He is the Professor of Finance here in the London Business School and as well the Director of the Hedge Fund Center at the London Business School. And of course the question for Professor Naik is, please tell us some insights of the latest research you have been conducting on hedge funds.
Thank you for coming to London Business School. As you know, we have had the first hedge fund research center in all universities. For the last 8 years, we have been having one. And with the center, what we have done is we have collected 5 different databases, the HFR, TAS, Barclays, Eureka Hedge, CISDM, and so on, created a union, removed the duplication, and tried to create as big a universe as one can get hold of. Once with that database that we have, we taken one step forward from instead of looking at hedge funds, we have started looking at the hedge fund companies, the management firms. So a given firm may be managing 10 funds, 20 funds, so on and so forth. So and these funds are not necessarily separate ones. So we are asking a question, if they could be class A, class B, class C shares, onshore, offshore, different currencies, different regulatory requirements from client's point of view. So when we did that, we realized that the capital entrusted by investors to hedge funds is concentrated in the hands of very small number of companies or people. To be precise, if you look at just the databases, we find that roughly 15% of the companies control 85% of the assets under management.
That's 15% of
Yes,
the companies?
Yes, 15. Just 15% of the companies control 85%. However, we also went beyond these databases and looked at the institutional investors' top 100 hedge fund list. And we were surprised to find roughly 45 to 50% of those names did not report to any of these databases that we consider as workhorse of the hedge fund investors. So we went into some investment banks and we approached them for some information on returns as well as the assets under management of these institutional investors top 100, and we combined it with these 5 databases, and we found the top decile, the top 10% of the companies now were controlling 85% of the assets. So the concentration is even greater, and when we tracked this performance from 2000 up to today, end of December 2009, we found the concentration has been increasing over time. In 2001, the top decile was controlling roughly 75% of the assets. Now they are up to 85% or more. Yeah? So this is joint work with my colleagues, Professor Bill Fung, who is a visiting research professor of finance here at London Business School, and Professor David Hsieh, who is a professor of finance at Fuqua School of Business, Duke University. I went to Duke for my graduate school, so I've known Professor David Hsieh for the last 22 years. So this joint research is what I would like to share with you. So we asked the following question. What do these companies, what do the survival probabilities of these companies look like? In the sense, what percentage of the companies which were in business in 2001 are still in business after the credit crisis of 2008 and more recently December 2009? And we started looking at it decile by decile. Yeah? So top decile are the big companies, the 10th decile, or the mega companies. We found that 90% of them, of the names, were still in existence, still managing a large amount of money. Not that the balance 10 have just died or liquidated. Some of them may have shifted to the 9th decile or the 2nd decile from the top by size, assets under management. Some have just stopped reporting because they have become so big that they don't need the advertisement or they don't want extra attention or to raise extra capital. Then we looked at the median decile, and we found roughly half of the names who were there in 2001, turn of the century, 1st of January 2001 are still in business. And if you looked at the small ones, the newly born, the young ones, 70% of them, or only 30% survived, 70% died. Some of them have moved to second decile, but a large number of them have just disappeared from this face of the earth. So what it tells us is, the bigger the company, they are able to manage their survivorship, or they manage the left tail risk, manage the funding risk, manage the asset side and the strategy timing much better compared to the smaller companies. Let me just take you through what their performance looks like, just to give you an idea. So since hedge fund industry is considered as an absolute return, we said how does their performance look like when compared to say LIBOR plus 3% or Treasury bill plus 3%. So the red line on the chart is LIBOR plus 3%. Then we compared how does the fund of hedge funds index, HFR fund of hedge funds index, track that line, how does it perform. HFR individual hedge funds, so fund weighted composite index, and then the Lippert TAS, Tremont TAS, AUM weighted hedge fund index. And what we found was they seem to be tracking this LIBOR plus 3% pretty closely until the credit crisis, where whatever gains they had, they lost, and now they are again up towards that trend. Then we asked the question, how about the blue chip names, the top decile companies? How do their flagship funds performance looks like? And what you find is the flagship fund performance is much better than the average, as one would expect. Just the way Roger Federer and Rafael Nadal's game is much better than the average tennis player's game, given that we are in Wimbledon season just now. Then we asked a question specifically about risk management. How did these mega firms do during 2008? So if I zoom in and have this January 2008 as the first starting point, what we find is the average hedge fund has lost a lot during 2008 and is recovering, and the red line is still our target, LIBOR plus 3%, while the flagship funds lost a little but have recovered much quicker. So clearly during difficult trading environment and market conditions and the credit crunch of 2008, these blue chip firms manage the funding risk or the left tail risk of their strategies much better. Just to we think about hedge fund risks as coming from both the asset side of the balance sheet, which is the asset classes they invest in, and the trading strategies they follow, as well as the liability side, which is the funding risk. How do they go about managing their leverage, their borrowing, their short side of the balance sheet? And clearly these blue chip firms seem to be doing better managing their funding risk, and we have analyzed that specifically by looking at their correlations with changes in credit spreads vis-a-vis changes in market returns like equities, bonds, and so on. And we find compared to the average, which loses money when the credit spreads widen, these blue chip companies, their correlation with credit spread changes is very small, indistinguishable from zero for all practical purposes.